Warren Buffett made a $1 million bet in 2008 that a single S&P 500 index fund would outperform a hand-picked portfolio of elite hedge funds over 10 years. The hedge funds had armies of analysts, decades of experience, and fees that reflected it. By 2017, the index fund had nearly doubled. The hedge funds averaged less than a third of that return. So here's what that actually means. The most sophisticated investors in the world, trying their hardest, lost to doing almost nothing. Why does trying harder make you worse at this? We have a deeply wired belief that results require effort, that expertise creates advantage, that complexity signals intelligence. In almost every domain of life, that's true. The surgeon who trained longer is better. The lawyer who prepares more wins more cases. But investing has this strange, counterintuitive property where effort, specifically the effort to outsmart the market, tends to destroy Silicon value rather than create it. This is what most people get wrong about the S&P 500. They think it's the cautious choice, the thing you pick when you're not confident enough to pick stocks, not sophisticated enough to find the next big thing. It's seen as financial beige, safe, stable, slightly boring, what you tell your parents to do. But that framing is exactly backwards. The S&P 500 isn't the coward's option. It's the option that has quietly humiliated professional money managers for 50 years running. It's not boring because it's mediocre. It's boring because it works so consistently that there's nothing dramatic to say about it. Here's the actual setup. The S&P 500 is an index of the 500 largest publicly traded companies in the United States. When you buy it through something like VOO or SPY or any number of index funds, you're not betting on one company. You're buying a small piece of the entire productive engine of the American economy. When Apple grows, you grow. When Amazon wins, you win. When a company fails and falls out of the index, it gets automatically replaced by something healthier. You're essentially holding a self-cleaning basket of the best businesses in the world's largest economy, and the machine just runs. You don't have to do anything. Let's talk about what the numbers actually look like over time, because this is where the story gets interesting. The S&P 500 has returned an average of roughly 10% per year over the last century. Some years it's up 30%, some years it's down 40%, but zoom out far enough and the line goes up. Always has. Through the Great Depression, through World War II, through the dot-com crash, through 2008, through a global pandemic, the line goes up. Now run the math on that 10% average. If you invest $500 a month starting at age 25 and you never touch it, by 65, you have somewhere north of $3 million. That's not a lottery ticket, that's arithmetic. The mechanism is compound interest, which Einstein reportedly called the eighth wonder of the world, though he probably didn't actually say that, but whoever said it was right. Money growing on top of money on top of money creates an exponential curve that looks almost unfair when you see it graphed. Here's a concrete image that makes this visceral. Imagine you fold a piece of paper in half 42 times. You can't actually do it, but if you could, that paper would reach the moon. That's compounding. The first 20 folds look like nothing. You're holding what seems like a thick pamphlet. Then, the last 10 folds do more work than all the previous 30 combined. Your investment portfolio works exactly like this. The first decade feels slow. The third and fourth decades feel like a cheat code. And the data on active management is genuinely brutal. Spiva, the research arm of S&P Global, tracks how professional fund managers perform against their benchmark indexes each year. Over any 15-year period you pick, roughly 90% of active fund managers underperform the S&P 500. Not because they're incompetent, because the market is efficient enough that their information advantage is thin, their fees are real, and their trades generate taxable events. The deck is structurally stacked against them. So what are the core forces that make this work? There are a few worth naming precisely. First, the fee gap is more devastating than it looks. A fund charging 1% per year sounds like nothing. 1%. That's the price of a mediocre sandwich per $100. But over 30 years, a 1% annual fee on a growing portfolio doesn't cost you 1% of your returns. It costs you somewhere around 25% of your final balance, because fees compound the same way gains do. Just in reverse. A low-cost index fund typically charges 0.03% to 0.1%. The difference between 1% and 0.05% is not 0.95 percentage points. Over a lifetime, it's potentially hundreds of thousands of dollars. Second, behavior is the real return killer, and simplicity protects you from yourself. Studies consistently show that the average investor earns significantly less than the funds they invest in. The reason is timing. People buy after markets have risen. They panic and sell after markets fall. They hear a story about a hot sector and chase it. The S&P 500 strategy, buy, hold, automate, ignore, removes most of those decision points. You can't panic sell your way into ruin as easily when your strategy is literally just do nothing. Third, diversification at this scale is genuinely underrated. When you own the S&P 500, you own a slice of 500 companies across every sector of the economy. One of them will be the next great company of the next decade. You don't need to know which one. You already own it. Fourth, the American economy has a structural growth bias baked in. Population growth, immigration, productivity gains, innovation, rule of law, deep capital markets. These aren't guarantees, but they're real tailwinds that have persisted across every political era, every policy regime, every crisis. Betting against the long-run performance of the S&P 500 means betting that the American economy stops growing. That's possible, but it's a different kind of bet than most people imagine. Now let's steelman the objection, because it's a real one. The S&P 500 is heavily concentrated. The top 10 companies now make up something close to 35% of the entire index. So you're not really getting 500 companies of equal weight. You're getting a portfolio that's effectively a bet on a handful of mega-cap tech companies. If those companies stumble, the index stumbles with them. There's also a recency bias concern. The S&P 500's extraordinary performance over the last 15 years has coincided with a historic bull market and historically low interest rates. Conditions change. Japan's Nikkei index hit a peak in 1989 and took over 30 years to recover it. That can happen. These are legitimate points. They're why some smart people argue for adding international diversification or small cap exposure. Those aren't crazy ideas, but notice what this objection isn't saying. It's not saying you should pick individual stocks. It's not saying you should time the market. The debate is about how to index, not whether to index. The core principle survives the criticism. So what does this actually mean for you? It means the most valuable financial decision you can make is probably one you can make in about 20 minutes. Open a brokerage account. Set up automatic monthly contributions to a low-cost S&P 500 index fund. Then do something more interesting with your mental energy. The wealth doesn't come from complexity. It doesn't come from watching CNBC or reading earnings reports or finding the right fund manager. It comes from time in the market, low costs, and the patience to not undo the compounding when things get scary. The person who does this consistently and ignores the noise will, statistically, outperform most people who are working much harder than they are. Yeah, that's the part that should feel surprising, not the returns, the simplicity. If you find this kind of thing fascinating, places where conventional wisdom gets the mechanism exactly wrong, this channel is built around exactly that. We go deep on how money actually works, not how it's usually explained. Subscribe, and the next video is already waiting for you.